I'm going to propose we take a breather here. And then when we come back, we will get started with another really exciting topic, topic 16. Um, and again, my hope is that folks have watched the lecture video. If you haven't, I don't think you have enough time to go very quickly and watch it on the sly. So just take a bit of a breather, go get coffee or something, stretch your limbs, and we will come back again in 10 minutes. So at 7:20, we will resume and we'll talk about topic 16. All right. So I'll just pause the recording for the moment. So now that we are back after the break, it's time for us to begin with topic 16. And topic 16 is basically about using forward contracts as a way of hedging against the risk of foreign currency exchange rate fluctuation. So the topic is on hedging. So in the lecture notes, as well as the lecture video, I talked about the various kinds of exposures that companies may have. And so primarily, we are focused on the risks that changes in foreign currency exchange rates pose translation risk, counting risk, basically. Pose various risks to companies depending on their relative circumstances. So for people that are exporters, if you think about economics, it's been a while maybe for many of us that we took economics. If you're an exporter and you buy, right? If you're an exporter and you buy, you source your goods in and have to pay for them in foreign currency, then a weakening Canadian dollar is beneficial. Sorry, if you're an exporter, you sell. Sorry, my bad. Importers buy, exporters are the ones that sell. And if you happen to sell in foreign currency, a weakening Canadian dollar is beneficial because now for the same amount of foreign currency, you will get more Canadian dollars. For importers, on the other hand, people that import stuff and have to pay for it in foreign currency. And keep in mind, even the US dollar is a foreign currency for us. So if our Canadian dollar weakens against the US dollar, and if you're importing stuff from the US, you will have to pay more for the material that you're importing. So a weakening Canadian dollar will be, what's the opposite of beneficial? A weakening Canadian dollar is adverse. Right? On the other hand, if you are an exporter, strengthening Canadian dollar, because the exchange rates can go both ways. Weakening Canadian dollar is beneficial, but a strong Canadian dollar, if you are an exporter, a strong Canadian dollar is not good, right? Whereas if you are an importer, a strong Canadian dollar is actually a benefit to you because you can then buy stuff from abroad cheaper. Right? So when I remember when our Canadian dollar was almost at parity, then a lot of Canadians, myself included, we would go down to the US and bring back stuff, right? Lots of stuff, because like it or not, there tends to be a difference in the Canadian dollar pricing for goods and the US dollar pricing for goods. And for the brief while that the Canadian dollar was actually on a par with the US dollar, it was way cheaper to go and buy stuff from the US. I know a good friend of mine went and bought a new car and ended up saving something like $8,000, $9,000 on the price of that new car that he paid in the US compared to what he would have paid here. So there were quite a bit, like, savings at that time. So depending on your position, changes in foreign exchange rates pose different kinds of risks. Now keep in mind that risk is something that can be quantified, and risk goes both ways. So you have a typically people think about the downside risk, which is the risk of loss, but there can also be the risk of gaining. We don't usually think of it that way, but risk in the world of finance is defined as basically the variability around an expected mean. And if that's the case, the variability can be on both sides. You can have your returns can be higher than expected. It's a risk, but it's an upside risk. Right? So that's a risk of a gain. Um, but most people, and most lay people at least, tend to think of risk. When we think of risk, we kind of couch it in language around the risk of loss. So if a business is concerned about risks posed by changes in foreign exchange rates, then there's a way of managing risk, right? How do we manage risk? Well, you can either avoid the risk completely, which means if you were, let's say, either an exporter or an importer, if you were concerned about the risk posed by fluctuations in foreign exchange rates, you might say, well, I'm only going to transact in Canadian dollars. So if you're an exporter, you'll say, I need to be paid in Canadian dollars. Well, that's the case, then there's no really risk. There's no risk for you, except for the fact, of course, that if the Canadian dollar were to appreciate relative to the other currencies, our goods will become more expensive for our buyers abroad, and then the demand for those goods might dwindle, right? If you're an importer, you could say, I'm only going to pay in Canadian dollars, and I want all my prices quoted in Canadian dollars. Well, you basically are avoiding dealing in foreign currency, and therefore that's fine. But that depends on whether you can do that. There are certain circumstances that you just cannot, right? If you happen to be a crude oil company, you're in an oil and gas, your sales prices are essentially quoted in US dollars. So you will get your prices in US dollars. And so how the Canadian dollar behaves, you really have no way of insisting that people that buy from you um, get into contracts in Canadian dollars, right? So you can't avoid. So when it's not avoidable, then like there is a risk for all of us that we might get a disease sometime. There's a risk that we could die unexpectedly, right? So that risk is there for each one of us. Some of us might have that stoic attitude that, whatever will be, will be. We will deal with it when the time comes. Or one could argue it as the folly of youth. When we are younger, we tend to think of ourselves as being invincible. So of course, c'est la vie, que sera, sera. You kind of, go your own merry way until I guess you kind of settle down, you have, you start a family, kids, etc., and then you start worrying about their safety. So it's no longer what happens to you. You could die for all you care. You don't give you don't have a care for your own personal thing, but it's like what would happen to your loved ones should you were to pass away. Well, then you kind of start worrying and say, so what do I mean? Of course there's um, the emotional side, but that can never you no one can replace that part. But if you have young kids, and you kind of think of yourself as also being the provider of means for them, the means of education, financial security, and so on. And that's where we kind of think about seeking insurance, right? So insurance, buying life insurance, keep in mind, there's no way that you can personally gain from life insurance. Like, the only way there's going to be a payout is if you die. So so the idea of insurance is an interesting one. Yeah. um, we buy insurance not to gain from it, right? Even for business situations, the idea is you should get insured not to make a profit from it. I know some people try to do it, and that's called insurance fraud and whatnot. Not talking about the fraudulent activities, but for most people, insurance buys peace of mind, right? Buys you calm, right? It allows you a means of making sure that what you want to protect against is protected. That you have, that you're not the only one, that you're not kind of leaving yourself to the mercy of the fates, but that there will be, in case of a financial loss, that there will be somebody to help out. For sure, insurance does not come without any kind of exclusions and so on, so we're not going down that path. But the basic idea of insurance tends to be that it helps us manage the risk. So if the risk is that exchange rates can change and bring about losses, well, there could be a way of trying to, if not completely eliminate the losses, then certainly to mitigate against them, to minimize the amount, right? So in the case of foreign exchange um, risk, the way we seek to manage our risk is through the use of a hedge. And you can think of a hedge as basically a way of insuring, right? So a hedge, um, in the English language, if you were to think about what the word hedge means, if you look at pictures of hedges, you kind of see these bushes around houses, right? So uh, bushes around the house, like what do? They keep some of the undesirable elements of the world outside of the house, away from the house, keeps the house sort of protected against some. Now, what could those be? Possibly some stray animals, etc. Just want cert, maybe outside noise, etc. Just kind of that hedge acts as a kind of a protective moat of sorts around. Yeah. So if you think of that concept, and then you think of a hedge in those terms, a hedge essentially is something that helps us manage the risk. And so when you're looking to hedge a foreign exchange risk, hedging an FX risk, there's different ways and that can happen. In our course, we are going to look at the use of forward contracts, right? So we're going to be using forward contracts as a hedging instrument. A hedge needs two things to exist. You must have a hedging item, and there must be a hedged item. So something that you are looking to protect. And in this case, what we are looking to protect is either some kind of a receivable or a payable that is denominated in foreign currency. Because if you think about the risk, so well, if we don't have any exposure to foreign currency, then there's no risk to us. Exchange rates could change all they want. If we don't have any exposure to foreign currency, then we don't care. We will only care if we are exposed to foreign currency amounts. And those foreign currency amounts would typically be either an amount that we are looking to receive in foreign currency or an amount that we will be paying in foreign currency, right? Why will we receive money? Most likely reason for that would be we made a sale, right? So we had sales in foreign currency. If we are going to receive that amount in foreign currency, we care about what happens to exchange rates, because depending on which way exchange rates move, we may end up receiving more Canadian dollars or fewer Canadian dollars. There's a risk of gain, there's a risk of loss. Why would we have a payable in foreign currency? Well, maybe we buy inventory in foreign currency, or maybe we buy some assets in foreign currency. Either way, if we have a payable, depending on which way the foreign exchange rates go, we might have end up paying more Canadian dollars and hence have a loss, or fewer Canadian dollars and hence experiencing a gain. So either way, again, there's a possible downside risk or an upside risk. Using forward contracts helps manage that risk. So what is a forward contract then? A forward contract is basically a contract where we get a fixed amount. When we use a forward contract, we get a fixed forward rate. We get a fixed rate to be able to buy foreign currency or sell foreign currency. Right? We enter into that contract with a financial institution, could be a bank or some other financial institution. It is a customizable contract where we can specify the amount of foreign currency that we would either want to buy or we would want to sell. Right? So if you were an importer, right? If you are an importer, you're buying stuff in foreign dollars, US dollars, euros, whatever, you would want to enter into a forward contract to buy the foreign currency from the bank. If you were an exporter and you receive payment in foreign currency, then you want to enter into a forward contract to sell the foreign currency. Right? So a forward contract is a contract to either buy or sell foreign currency, right? So forward contracts are contracts to buy or sell foreign currency at a later date, right? So you are not going to buy or sell the foreign currency immediately. You are going to do that at a later date. However, you get a fixed rate now when you sign the forward contract. You sign the contract, you're guaranteed an exchange rate, right? You're guaranteed an exchange rate. So you won't lose money because you're guaranteed the rate. So whatever rate you sign up for, you know exactly how much cash you will have to pay if you're buying foreign currency, or you will be receiving if you were to sell foreign currency. So once you know for sure how much your cash flow is going to be, I hope you would agree that knowing for sure how much you're going to get or how much you have to pay kind of reduces the anxiety that's brought upon by not knowing what will happen. But that said, if things turn out rosier than you had anticipated, then usually people end up getting buyer's remorse, right? There's always that kind of thinking in the world of insurance. Like you take comprehensive insurance on your car, nothing happens. You look back at the year and you go, oh man, I just wasted my money on the insurance. Or a typical example would be my dear mom, who, if we send her for a comprehensive health checkup, costs a few $100s in India to get that done. And her first thing is, they did all these tests and they didn't find anything. I don't know if you can relate to that, but the whole idea was let's hope nothing comes up, right? But the point of testing is to make sure. But there's folks, especially, well, in Canada, I think it's maybe not as relatable because we don't pay for our healthcare. But where you do have to pay, people often avoid going to healthcare people, to the doctor, or getting health tests done, because it's going to be an out-of-pocket cost for them. And so they end up waiting for things to get as bad as they can, right? As long as they can hold back, there's no point in spending money because that's just going to be a waste of money. And so if you wait for too long, then of course things will be bad, and that ends up being the story of their lives. uh, Insurance, if you get life insurance, younger people tend not to want to buy life insurance because they believe that they're not going to die anytime soon. So they think paying for the insurance cover is a waste of their money, right? And that's the thinking, because you're kind of thinking, let's just save on that because nothing's going to happen to me. But later on, if you were to look to buy life insurance at a later stage, or if you know for sure that you have developed some kind of a morbidity, either in terms of diabetes or something of that nature, or Lord forbid, you get develop a cancer of some sorts and whatnot, you might not even qualify for the insurance. And that would be the time when you'll be most anxious, if you have young kids, etc., man, that's going to keep you awake at night and so on. But even if you get the insurance cover at that time, it will be at very high rates, right? So for those of you that have taken accounting theory, you can probably relate to that. That's your adverse selection, moral hazard, the information asymmetry problem that comes from the world of insurance. Adverse selection is the risk for the insurers that they will end up covering people that are high risk. Moral hazard, on the other hand, is that once people are covered, they tend to throw caution to the wind. If I know that I have a couple of $1 million of life insurance, and I know that that's enough for my family to be taken care of, I might have diabetes and I'll take zero care of myself. I'll, eat whatever I want, as much, of unhealthy stuff as I want, because YOLO, right? You only live once. I die, well, my family is taken care of. The moral hazard right there. You end up people taking actions that they shouldn't be, taking risks that they shouldn't be, because ultimately it's somebody else that's going to pay for it. Yeah. So I don't know why I went down that route, but bringing you guys back, right? Circling you folks back into the concept of insurance. Keep in mind that insurance doesn't come for free, right? There is no free lunch, and insurance is not free. So typically, what ends up happening is that when you sign a forward contract, the forward rate that you typically get tends to be um, a little bit against you. So it tends to be a little bit uh, higher, if you will, or than the spot rate. So because it adds the element of time value to it, right? There's an element of time value that is added. So this forward rate tends to include that extra bit of premium for the peace of mind that knowing what exchange rate you are guaranteed to get can bring. Right? So that's usually why at the time you sign a contract, a forward contract, the forward rate that you get is different from the spot rate. Over time, though, the two rates converge. So when the forward contract expires, the spot rate on that date and the forward rate on that date are equal. So when you start out, you will see a difference between the spot rate. Spot rate, by definition, is the rate that you get if you want to buy or sell foreign currency right now. Forward rate is a rate that you can get right now. You get this rate guaranteed, but the actual transaction is going to happen later on. So if that were the case, you will typically find the spot rate and the forward rate won't be the same. But over time, as time goes by, the two rates will converge. Okay? So I'm going to take a look at an example to help explain it a little bit better. So on April 1st, 2012, Praxa Corporation bought merchandise from a vendor in Rome, Italy, where the local currency is the euro, for 200,000 euros. Terms of the sale called for payment on May 31st, 2012. As an international customer, Praxa agreed that the order was non-cancelable, or means the title to the goods bought transferred to Praxa immediately on placing the order. Immediately after placing the order, Praxa entered into a forward contract with the bank to buy 200,000 euros on May 31st at a forward rate of 1.63. Praxa's year end is April 30th. You're given some rates, and you're asked to record the journal entries for the above transactions in the books of Praxa. So this here, I'm going to use this example here to demonstrate how using a forward contract can help reduce the overall FX risk. But primarily the function of the forward contract, its function is to make sure that you get a fixed lock. So before I move on, I want to take a look at what the hedged item is and what the hedging item is. The hedging item will always be a forward contract for us in the course. The hedged item can be a receivable or a payable in foreign currency. Praxa, it's going to be the accounts payable in euros. It's buying inventory. The forward contract is a forward contract to buy euros because Praxa needs euros to pay its supplier. So that's conceptually how the setup should be. Now, how will the hedge work? For the hedge to work, so say the accounts payable in euros. So say the euro was to depreciate against the Canadian dollar. Euro was to fall against the Canadian dollar. Well, what will happen vis-a-vis the accounts payable in euros is there will be an FX gain. On the forward contract, though, because your forward contract is to buy the euros, the value of your forward contract will fall, resulting in an FX loss. What's important to note is you're going to have an FX gain on the hedged item, which will be offset by an FX loss on the hedging item. It may not be a clean offset. It may not be a dollar for dollar offset, but certainly the total amount of the FX gain or loss will be reduced. But euro could appreciate against the Canadian dollar. If that happened, you're going to have a loss on the accounts payable. But since you're going to be receiving euros from the bank, that will be a gain, right? So the euro appreciating would mean a gain. So again, loss on the hedged item will be offset by a gain on the hedging item. So a properly functioning hedge should have the hedged item and the hedging item being affected in opposite directions. That is critical. The hedged item and the hedging item should be affected in opposite directions by whatever risk that is being sought to be managed. So over here, if it's the risk of changes in exchange rates, the changes in exchange rates should affect the hedged item and the hedging item in opposite directions, so that a gain on one of those is offset by a loss on the other, or a loss on one is offset by a gain on the other, right? It is very important that you understand the theory here. The accounting is not that difficult, but without understanding the theory, it's like Greek. You won't get much out of it. So if you think there's anything you need me to repeat or explain again, this would be your time. No? Okay. Let's take a look at the transactions one by one. We placed an order. It's a non-cancelable order, which means title transferred to Praxi immediately on placing the order. If that happened, we have to record the purchase of the inventory. So debit inventory, credit the accounts payable. Inventories purchased for 200,000 euros. Spot rate on the date we place the order is April 1st, 1.65, 200,000 euros at 1.65. Debit the accounts payable, debit the inventory, credit accounts payable in euros. The equivalent Canadian dollars are 330,000. On the same date, we went ahead and signed a forward contract with the bank to buy 200,000 euros. So we will receive from the bank 200,000 euros. We will have to pay to the bank Canadian dollars. Since the forward contract is to buy 200,000 euros and the exchange rate we got, the forward rate that we got is 1.63, well, we record the receivable from the bank, credit payable to the bank, $326,000. Now, just looking at the spot rate and the forward rate, it appears that the foreign exchange markets expect the euro to depreciate relative to the Canadian dollar. At least at that time, on April 1st, the foreign exchange markets expected that the Canadian dollar will appreciate relative to the euro, or the euro will fall relative to the Canadian dollar. Why that happens is a whole lot of economics. There could be changes expected in the interest rates. There could be uh, um, adverse changes in the balance of payment and so on, right? The trade deficits, et cetera, just too many things out there. So don't ask me why the rates would differ, but it just looks like that the markets were expecting the rates to be lower. So our company has gone ahead, signed a forward contract at 1.63, whereby they will be receiving 200,000 euros from the bank, and they'll have to pay the bank $326,000 in Canadian dollars. Now, what you will notice is that we have an accounts payable that is denominated in euros. So as exchange rates change, this guy, the accounts payable in euros, will change in value because it's a monetary liability. Make a note of it. Not seeing a lot of notes happening here. Accounts payable in euro is a monetary liability. Being a monetary item, it will need to be adjusted at year end. And our friend Praxa has an April 30th year end. So come April 30th, the accounts payable in euro will need to be adjusted. Similarly, the receivable from the bank, which is the portion that is in euros. So a forward contract always has two parts, a receivable and a payable. So on the date that you signed the forward contract, you debited the receivable for 326, credited the payable for 326, the net amount is zero. So if you look at your textbook solutions, in your textbook solution that says no entries needed, just a memo is good enough because it's just it's just an executory contract here. They're right, except that people don't tend to learn these stuff well using their approach. Your textbook solutions are all prepared using the net method. I prefer to use the gross method, and the gross method is something that even CPA Canada prefers because it's easier to follow what's happening. So we have got from the bank a guaranteed rate. So we know exactly how much we have to pay. We will have to pay to buy the 200,000 euros. We will only need to pay $326,000. That's it. Our cash flow is fixed. But from an accounting point of view, this contract, because it's an executory contract, we are bound to have to buy the 200,000 euros from the bank. So we've signed a non-cancelable contract with the bank as well. Now, what happens if there was any issue with the inventory we received from our Italian suppliers? Well, we may take them to court. We may not want to have, pay them the 200,000 euros. We may ask for damages, et cetera, et cetera. Guess what? If you sign the contract with the bank, you can't get out of that contract without having to settle it. So that is important. You are bound now by contract to pay the bank $326,000 and receive from the bank 200,000 euros. What you do with the euros is basically your issue, your matter. All right. Now, the euros that you will be receiving, as exchange rates change, the value of those euros is going to change. So that is why, as time changes, the forward contract, the forward rate changes. The forward rate is based on changes on the spot rate, right? So it goes in the same direction. So notice from April 1st to April 30th, the spot rate changed from 1.65 to 1.71. That's a change of 6 cents. The forward rate changed. It changes in the same direction. It goes up, but not by the same amount. Right? It goes up by a different amount. And that is, as I was explaining, due to a whole lot of other macroeconomic stuff that just beyond the scope of this course for me to try to explain. Not a trained economist, so I lack the authority over the subject matter, but I can tell you there's a whole lot of other things that'll have an impact on how spot rates will change and how forward rates change. Forward rates are based on expectations. within the market. But the direction of the change tends to be the same. So if the spot rate goes up, forward rate goes up as well. As a result of the forward rate changing, the receivable from the bank in euros will also change. And this is a financial instrument, right? The receivable, the forward contract is a financial instrument, and financial instruments have to be reported at fair value on the balance sheet. So April 30th being a year end, we need to determine if there's been any change in the fair value of the forward contract. The amount payable to the bank is frozen. That's not going to change. That will stay 326,000. What changes is the value in Canadian dollars of this portion, the receivable from the bank. Because the receivable is denominated in euros, the receivable value will change as the forward rates change. So that, because the receivable from bank in euros, that forward contract portion is going to change in amount, there will be an FX gain or loss resulting from that. Okay? So we need to take a strong, hard look on April 30th on both our accounts payable. So our accounts payable, we originally recorded at 330,000, and that was on April 1st, 2012. And the receivable from the bank, we recorded originally at 326,000. Now, both of these amounts are 200,000 euros. However, the accounts payable, the value of the accounts payable depends on the changes in the spot rate, and the receivable from the bank, the forward contract, basically, its value depends on changes in the forward rate. So remember, forward contract, forward rate. Everything else, spot rate. So as of April 30th, the accounts payable of 200,000 euros has to be measured using 1.71. So if you multiply 200,000 euros by 1.71, you'll get $342,000. Our accounts payable value went up, the liability went up. Because the liability went up, it means there is a, so how do you record it? The liability went up, you want to credit the accounts payable liability and debit FX loss. But by the same token, we also have a change to the forward contract because the forward rate has changed. It's now 1.72. And so 200,000 euros times 1.72 works out to 344,000. So this receivable from the bank in euros has gone up in value in Canadian dollars to the tune of $18,000. To record that fact, you would debit the receivable from the bank and credit an FX gain. Right? So notice here, we had an FX loss on the accounts payable liability, and we have an FX gain on the forward contract. The dollar amounts are not identical. The FX loss is $12,000. The FX gain is $18,000. It's just coincidence, right? However, if you think about what the net amount will be for the FX, the net amount that is reported will offset the loss against the gain. So you're just going to report a $6,000 gain. Now, mind you, we never got into the forward contract with a view or an objective to profit from it. Right? So that was not our objective. Sometimes people just get hung up over those consequences. And I reiterate, folks, just keep in mind, you do not get insurance to profit from it. Unless you are willing to commit fraud, you're never going to profit from insurance. Insurance buys you peace of mind. It lets you sleep with calm at night, but it's going to come at a cost. Okay, so more often than not, you will see losses. It could be a gain, it's just an accounting outcome. Okay, do not give yourself a pat on the back and say you were a superstar to have thought up this strategy. No, you didn't, you just got lucky. Right? That's how life plays. So don't read too much into the net implication. Just see that the loss on one item is being offset by the gain on the other. It could be offset entirely, it could be overcompensated as the case is, or we could have had an FX gain that was a little bit lower than the 12,000. That's just how life is. All right. Now it's really important that you understand the economics of what's happening, like really what's taking place, rather than getting stuck with the debits and credits. Because in my experience teaching this course, like I know that some other instructor colleagues don't even teach this stuff. Okay. So if you have friends in another course, they're probably not even getting into this stuff, into this detail. They're just not covering it. Right. And they'll blame it on COVID, say, this is COVID. Yeah, we're just not going to go down that path. I am teaching you this stuff because it's important. Why is it important? Well, being a Canadian, like Canadian companies, especially in Calgary, if you're going to be working for a Canadian company based in Calgary, you are going to encounter situations where you have transactions in foreign currency. And most companies of any decent size will have some ways of hedging in place. So if you don't understand what's taking place, you're just going to be outside of that league. You're basically going to be doomed to be the the junior accountant for life. And if you're happy earning $50,000, $55,000 for the near foreseeable future, 15 years, 20 years, well, then good luck. I have nothing to say there. But if you hope to be at a higher pecking order within an organization, you need to know your stuff. Don't know your stuff, you're not going to make it. All right. Doesn't matter where you're coming from. So that is why I say this stuff is important. It's complicated. It's maybe a little bit harder. So if you put in the effort, I'm here, like I am an award-winning teacher. I take pride in my understanding, but I also expect the same from my students. So I'm not going to take kitty gloves to you, but I want you folks to be mindful that I'm doing it for your benefit, and reciprocate. Ask questions when it doesn't make sense. No, this is complicated. Mano a mano, exactly, right? Full bare knuckle. There you go. Like I don't have to inflict blows on you guys, right? Love you all, but life is hard. So, anyhows, you can tell that I'm very inspirational. Um, so what happened? Well, May 31st, we have to make payment, right? May 31st, you got to make payment. So May 31st, you got to make payment, and the payment has to be in euros, right? You have to pay your supplier, your Italian supplier, in euros. You need the 200,000 euros. You don't have the euros. Where are you going to get the euros? Well, you're going to call up the bank for your euros. And you call up the bank, and the bank says, yeah, sure, let's take a look, etc. Yeah, looks like you have to pay us $326,000 in cash. So the bank is not going to give you the euros before you pay the banker. So you pay the banker. Debit payable to the bank, credit cash, 326,000. You pay the banker then gives you the euros, right? The banker transfers the euros to your account. How many? 200,000. Now, on May 31st, the rate for the euros is 1.68. So your 200,000 euros that you get credited for in Canadian dollars are worth 1.68 times 200,000. So you get the euros, the cash, right? You debit cash for the euros, 200,000 euros times 1.6, 336,000. In paying you the euros, the banker has completed their duty. See, there's no more receivable from the bank, yeah? The receivable from the bank, which was $344,000 calculated as of April 30th, is no longer there. So you credit the receivable from the bank, close it out, but you're staring at an $8,000 debit difference for the two amounts. And that debit difference is an FX loss for us. Because the darn spot rate declined from 1.71 to 1.68. Oh, sorry. The darn forward rate declined from 1.72 to 1.68. The 4-cent drop resulted in 4 cents times the 200,000 euros, an $8,000 loss for us. This is just the outcome of the accounting, right? You didn't have any control over which way the exchange rates were going to go anyways. Now, what do you do with the euros? Before you can even sniff the euros, you're likely not even going to be able to sniff the euros because you don't actually receive the currency notes. It's just an amount that shows up in your bank account. You have to make the payment. You have to pay the euros. You send the wire transfer over to your supplier in Rome. Voila, the euros have left the cafe or the bar or wherever you're at. So you send the euros over to your supplier, and that means you have repaid the accounts payable, $342,000. Now, the euros that you sent their way had a Canadian dollar equivalent of 336. The difference is an FX gain. FX loss, FX gain, it's just an accounting outcome. You had no control over this. Bottom line, you went to the bank, got the euros, right? You got the euros from the banker that closed your forward contract for you, sent the euros over to your supplier in Rome. You no longer owe your supplier in Rome. There is peace and harmony in the universe. Okay, does that make sense? All righty. Now, is it just me, or are you folks also sensing that the material has gotten maybe a little bit easier compared to consolidations? It feels easier is what I should say. I mean, it's not necessarily easy, but it possibly feels a little bit more logical, right? Okay. So it just means we don't have to study as hard for the final, right? Don't fall for that, okay? Do not fall for that. Do not fall for that. So don't go down that path. Now, there's a whole lot of accounting that's happened here. Let's just summarize it. What were we trying to do? We were going to buy inventory, right? So how much was the cost of the inventory? Well, we've debited inventory for $330,000. So cost of the inventory, $330,000. We recorded the inventory for. What did we pay for the inventory? Well, look at this. The euros came in, the euros went out. That was just a wash. The actual cash that we had to pay was 326,000, which, mind you, we knew all along, because when we signed the blessed forward contract, we knew that we had to pay the banker $326,000 to get the 200,000 euros. So the cash we paid for the inventory is $326,000. So if you ask yourself, I bought inventory worth 330,000 and I had to pay 326,000 for it. So did this transaction result in a gain for me, or did it result in a loss for me? On the whole, a gain, right? I got $330,000 worth of inventory and I only had to pay $326,000 for it. It was a gain, right? So there's a total gain of $4,000 in this picture. If you track the FX pieces, so the year end was April 30th for this company, right? April 30th is the year end. So before April 30th, so as of April 30th, we recorded a debit of FX gain 12,000, credit 18,000. So loss of 12,000, gain of 18,000 for the fiscal year 2012. So the fiscal year that ended on April 30th, we had a $6,000 FX gain. Where did that come from? 12,000 loss, 18,000 gain. That's a net gain of 6,000. In fiscal 2013, so between the period May 1st to May 31st, if you look at it, we have a loss of 8,000 and a gain of 6,000. Loss of 8, gain of 6. The net is $2,000 loss. So between May 1st and May 31st, we have a loss of 2,000. $6,000 gain, $2,000 loss. The net amount is clear to you. For the entire duration of this series of transactions, we had a total gain of 4,000. Right? So the forward contract was supposed to deliver on 2 counts. One, it was supposed to get us a fixed rate as far as cash flows go, right? We wanted to get, so the forward contract, right, when we use a forward contract, first of all, we should be able to fix our cash flows. Were we able to fix our cash flow? The answer is yes. 200,000 euros, we had to pay a rate of 1.63. That was guaranteed. That's what we got. The second thing, using the forward contract as a hedging item should result in a reduction, a minimization of the FX amounts. So if you take a look at it, well, that's what happened. If we did not use if we didn't have the FX in play, but if we didn't have the forward contract in play, we would have had a $12,000 loss being recorded on April 30th on the accounts payable. And then we would have a gain of $6,000 recorded in the next year. With the forward contract in place, that loss was reduced from 12,000 to 6,000. Sorry, that loss was actually changed to a gain of 6,000 for the first period of time. And that gain of 6,000 was reduced, well, a little bit overcompensated though, to a $2,000 loss. Overall, we ended up with a $4,000 net gain for the entire duration, considerably smaller than what the amounts would have been had we not had the forward contract. And certainly, if we did not have the forward contract and had to go with the spot rate, remember, if we had waited, if we did not have the forward contract at all, and we had to make our payment on May 31st, how much would we have to pay? Well, at 1.68, we would have had to pay $336,000. Right? So we were able to pay $326,000 for the inventory. right? So we were better off there. And secondly, the overall FX was reduced. Okay, are you guys sold on that or no? Yeah, the difference between the inventory costs that we recorded, 330,000, and the cash paid 326,000. Well, that's basically your 4,000 FX. Of course, the 4,000 FX is split from April 1st to April 30th. Because April 30th was a year end, it's broken down to $6,000 gain and $2,000 loss. But you can see that the net amount is $4,000 gain. Okay, so if we got that part out of the way, then let's take a look at example 16.2. So same facts as in 16.1, except that the title to the goods doesn't pass until delivery, i.e. the terms are FOB destination. Now, if your terms of purchase are FOB destination, then you don't get to record the purchase of the inventory and the corresponding accounts payable until the inventory is delivered. So assume that the goods are delivered on May 31st, 2012. Convenience, well, now it's a little bit different because we won't have a complete hedge relationship. The reason for that is, in order for a complete hedge relationship, you need the hedged item and the hedging item. So we're going to get into a forward contract. You're going to have a forward contract in place, but there's not going to be the accounts payable in euros because the accounts payable in euros doesn't get recorded until the goods are delivered. The goods aren't going to be delivered until May 31st. So just think about the concept of circuits, circuit breaker. Like if you have a circuit breaker, electric current can't pass, right? So in order for the circuit to be complete, all nodes have to be connected. For a hedge to be complete, you need both the hedged item and the hedging item to be on the books. So in 16.2, if the purchase is FOB destination, then we will not be able to debit the inventory and credit accounts payable on April 1st. Won't have an accounts payable in euros on the books, then the forward contract isn't really able to protect anything because there's nothing to protect. So you have an incomplete hedge relationship. But because the forward contract is a financial instrument, you still have to adjust it on April 30th. And so what happens in this case is any resulting gain or loss in the forward contract will have to be reported in profit and loss. Unless the company decides to apply hedge accounting. Hedge accounting is about making sure that you match the recognition of gains or losses on the hedging instrument against losses and gains on the hedged item. So you can actually match the timing of the recognition. That would mean if you don't have the hedged item on the books, you can defer, you can not record the gain or loss on the forward contract into P&L. In order to do that, what Praxa will have to do is choose whether it wants to designate the forward contract as a cash flow hedge or a fair value hedge. Those are two possible choices it has. Either one will result in the gain or loss on the hedging, the forward contract, to not being recognized in profit or loss. Instead, the gain or loss is recorded in other comprehensive income if you use the whatchamacallit, the fair cash flow hedge designation, and in commitment asset liability if you were to use the fair value hedge designation. Now, the use of other comprehensive income or the commitment asset liability account is only allowed until we have the hedged item being recognized. So once the hedged item is recognized, we will close out the OCI and the commitment asset liability against what gave rise to the hedged items. If you kind of go back and sort of ask yourself, the hedged item, well, what was our hedged item? Our hedged item was supposed to be the accounts payable. Now, why would a Praxa Corp have accounts payable in euros? What is the reason for an accounts payable in euros to exist for Praxa under the circumstances? The purchase of the inventory. Exactly. So once the inventory is delivered and you record the accounts payable in euros, the OCI or the commitment asset liability balance is closed against inventory. Okay. So I know that without resorting to the numbers, it's harder for us to follow. So I'm going to very quickly get you through the accounting. So I'm going to show you what happens if Praxa does not apply hedge accounting. Okay. And then what happens if it does apply hedge accounting. You can do the comparison in your heads. So if 16.2, remember, what's happening is the purchase of the goods is such that title doesn't pass until delivery. So if title doesn't pass until delivery, there is no journal entry recorded. Okay, I'm just going to have to hide this bit if it's okay. I'm just going to hide these rows that it's easier for me to scroll up or down. So we won't record any journal entry for the order because the order is FOB destination. So you're not going to debit the inventory. You're not going to credit accounts payable in euros. However, you went ahead and signed the forward contract with the bank, so you need to record the forward contract. So you have the forward contract now. And that's recorded using the forward rate. April 30th, whether you like it or you not, because the forward contract is a financial instrument, you have to make sure that you report the forward contract at fair value. And the fair value for the forward contract is dependent on the forward rate on April 30th. And the forward rate on April 30th is 1.72, which means the receivable from the bank in euros is 344,000 compared to the original 346,000. Means it's gone up by 18,000. So come April 30th, if we don't apply hedge accounting, you will need to increase the receivable from the bank by 18,000 and credit the FX gain or loss. Here, it's an FX gain. That FX gain will be reported on the income statement as a gain. On May 31st, the goods are delivered. So once the goods are delivered, you'll debit the inventory, credit accounts payable. The spot rate for May 31st is 1.68. So you will debit the inventory for $336,000 using the 1.68 rate and credit accounts payable. And since the payment is made on delivery, once you receive a confirmation that the deliveries occurred, you have to now go ahead and make the payment to your supplier. You wait for confirmation that the deliveries happened. Then you need the euros. You go to your banker or you call them up, whatever it is. The banker says, pay us the $326,000. You pay the 326. You receive the euros from the bank. That results in FX gain or an FX loss being booked of $8,000. You use the euros to pay off the accounts payable. End of story. So the situation here is a little bit different from what we saw in 16.1. Yeah, the sequence of events has been altered, has been changed, and the result is a slightly different scenario. The cost of the inventory now is 336,000. The cash that we paid is still 326,000. The euros came in, the euros went out. So the euros did not really affect our cash flow. We actually paid $326,000 cash because that's what the forward contract was supposed to do. It was supposed to fix our cash flow, right? So we got a fixed on our cash flow for the 326,000. But because the inventory was recognized on May 31st, we recognized it at 326,000. The difference between what we recognized the inventory for, 336,000, and the cash that we paid, 326,000, tells you that there's a $10,000 difference, and that $10,000 difference is an FX gain. That is explained by taking a look at these two numbers. We have an FX gain booked on April 30th, $18,000, and an FX loss booked on it on May 31st, $8,000. Net amount is an FX gain of $10,000. But if you think about what gets reported on the income statement, for the year ended April 30th, we would have an FX gain of 18,000 being booked. And for the next year, we would have an FX loss of 8,000. What FX adjustments do is they create volatility in reported income. Now, if volatility is seen as a sign of risk, you can't guarantee that the outcome of the FX changes is always going to be a gain. There could be gains, there can be losses. So when you have huge amounts of gains, your income number will be high. When you have lots of losses, your income number would be low. Now you can say, well, that's just how accounting goes. But for people that are not intimate with how your company operates, to them, if your net income number fluctuates too much, it is indicative of underlying riskiness. And when people look at risk, they're either spooked and they will not invest in your company, or they may not be spooked enough to not invest, but they will demand a higher rate of return. And when investors demand a higher rate of return, well, that is experienced in the form of lower stock prices. Because if you go by the world of finance, the company stock price is basically the discounted cash value, the discounted value of the expected, either the expected stream of dividends, if you think about the dividend discounting model, or if you apply Olson's model, it's the the present value of the abnormal earnings power of the company. Again, this is for those people that have taken a course in accounting theory. You will agree, well, this is basically what ends up happening. So it is important that companies try to minimize the volatility in the reported net income if your reported net income tends to be too volatile, too gyrating, then market participants will see that as a sign of risk and will demand compensation by way of higher rate of return. Higher rate of return on the market means a lower stock price, and that's not beneficial to existing shareholders or to managers that might have stock options in play and so on. So you use hedging to minimize the impact of FX gains and losses. Clearly, in the absence of the hedged item, the forward contract was not able to act as an hedge. When you have nothing to protect, right? You can't claim, you'd be Don Quixote, right? You'd be a knight in shining armor or rusting armor looking for princesses to protect that aren't there. So you can have a forward contract in place, but if it's not acting as a hedge to an existing item, it's useless because it itself is going to generate FX gains and losses that will be reported in income without anything to offset. Of course, it does have the effect of fixing your cash flow. Yeah. So if Praxa does decide to apply hedge accounting and designates the forward contract as a cash flow hedge, that's what I was trying to get at. If hedge accounting is applied, then it's basically the same series of transactions, but with one very important distinction. And that important distinction, I hope, and that would be the last bit that I want to talk about for tonight. We won't get into exercise 16.3 or anything. The last bit that I want you folks to keep in mind is this shift from no hedge accounting to hedge accounting. All right. If you use hedge accounting, then what ends up happening is rather than record the FX gain or loss on April 30th, instead of crediting the FX gain, you credit other comprehensive income. So rather than use an income statement account, you credit other comprehensive income. OCI, remember, is not part of the income statement calculation. Earnings per share is a number that's calculated based on net income. OCI is never involved there. So you separate the impact of the change in value of the forward contract and park it in other comprehensive income. Even later on May 31st, when you collect the euros, rather than debiting the FX loss, you debit other comprehensive income. And so what happens now is you'll have a balance of $10,000 in accumulated OCI for the cash flow hedge. $18,000 credit, $8,000 debit. This 10,000 net amount, once you have recognized the accounts payable in euros, you want to close it against the inventory, as we said here, what gave rise. So you would close the OCI. In order to close the OCI, you need to debit the OCI. So debit OCI, credit the inventory. I also showed you how it'll play out if Praxa applied hedge accounting and had designated the forward contract as a fair value hedge. But in that case, the only change is instead of using other comprehensive income, you use commitment asset liability. Same accounting otherwise. So what does all of that distill down to? If we don't use hedge accounting, the inventory is recorded at 336,000. We paid $326,000 in cash because that's what our forward contract obligated us to do. But we ended up recording a net amount of $10,000 of FX gain, $18,000 up to April 30th, and an $8,000 loss subsequently. If we use hedge accounting, cash paid is $326,000. And because we do not book any of the FX amount, and instead choose to use other comprehensive income or commitment asset liability, and then close the OCI and the commitment asset liability against the inventory cost, the cost of the inventory recorded is 336 debit minus the $10,000 credit. So the net cost recorded for the inventory ends up being 326. So we obtain two objectives here. Using the forward contract, we are able to get a fix on our cash flow. And then by applying hedge accounting, we were also able to avoid recording the FX amounts because the payment was on delivery. None of this FX amount showed up on the income statement, but were rather offset against the cost of the inventory. The cost of the inventory is equal to the cash we paid, the best possible outcome.